as well. And furthermore, the SEC classifies tokens into security tokens versus utility tokens. That seems to course a classification. Can we do a better job based on their economic functionality? And if we do that categorization, do we observe segmentation similar to what we observe in international asset pricing? Those are issues we want to look at. So the first part of the paper is, to some extent, methodology-wise, it's not very innovative, but it's a necessary step. We want to look at what type of anomalies there are associated with cryptocurrencies. To do that, we build a rich data set of over, we start with over 8,000 cryptocurrencies, but after various filters, we get it down to about 4,000. We also get fundamental characteristics of over 600 cryptocurrencies from into the block. These are on-chain P2P kind of transactions and various metrics such as addresses of wallets for these cryptocurrencies in order to document the crypto anomalies. And from there, we identify two new, you can call it anomalies, you can call it premia. One is value premia, the other one is network adoption premia. In addition, earlier studies have shown momentum effect is there for cryptocurrencies. We show that it's only for large cryptocurrencies. Actually, for most of the smaller ones, there is actually a reversal effect. And from that, we build these two new factors. One is the value factor, crypto value factor. The other one is crypto network adoption factor. Add them to well-known factors such as crypto market factor, crypto size factor. We also add in a momentum factor. And from that, we propose a so-called C5 model, a 5-factor pricing model, and show it really performs well compared to other benchmarks, other combinations of these factors. So that's the first part. The second part takes us to token classification. We actually manually classified all 616 cryptocurrencies into 4 general categories: general payment token, platform tokens, product ownership tokens, and also cash flow-based security tokens. We describe their characteristics, aggregate patterns within each category, but more importantly, we show their strong market segmentation across the token categories. That means the classificational categorization is important, and at the same time, we think of factor pricing models. It's important to use local and international factor models, at least at this stage, instead of global factor models. I don't have time to go into the details of the literature. Safe to say there has been theoretical work on network effect user adoption and empirical attempts to capture that network effect. There are earlier attempts to measure value premium. Some studies, such as the early work by Liu and Tversky, didn't see a value effect, at least when it comes to predicting index returns. But their more recent study actually finds that there is a value effect. Our contribution is really to document it using a different value metric and also relate that to factor pricing. So let me move on here to describe the data. We get data from 2 main sources. One is the trading data from CoinMarketCap. We exclude stable coins and coins with 0 prices or market cap or trading volume throughout all periods. We also take out data that contain certain errors. For example, the price or market cap changes with 0 trading volume, basically inconsistencies in the data. For crypto characteristics, we get data from into the block. Over there, we have 834 cryptocurrencies. After merging and matching with CoinMarketCap data, we have 745 left. So we're going to call the full filter sample of over 4,000 tokens from CoinMarketCap as our full sample. Just for comparison with the earlier study of Lyutovsky and Wu, we also follow them to construct a large cap sample where we only include cryptocurrencies with market value bigger than $1 million US. And then for the data with characteristics, 616 of them, we call that our core sample. And the core sample is largely representative of the full sample in terms of market cap, aggregate market cap. In terms of number of cryptocurrency, you can see it on the right panel here. There are many, many small cryptocurrencies. So let's look at basic return patterns. We basically look at 13 cryptocurrency characteristics that can be grouped into 4 categories. We do single source and double source. Here, I'm just showing you the size effect. Basically, we sorted into 10 deciles weekly rebalancing of the formation of the portfolio. And you can see there's a significant effect in terms of size, market cap. Here is momentum. Actually, for momentum, for the full sample, we don't see a consistent pattern. That means momentum, if we look at the full sample, is not quite there. However, if we do double source together with size, you can see for the largest quintile, there is momentum effect. That's consistent with earlier studies. But for the smaller 4 quintiles, there is actually reversal. We basically form it for 1 week and look at the next 1, 2, 3, 4 weeks. And here I'm presenting 2 weeks pattern. And we also construct network adoption metrics using changes in total address, changes in total addresses with non-zero balance, changes in transaction volume, and also both measured on chain. And that's where the into the block data would be helpful. It turns out that growth in addresses generate significant premium. And that's what we are going to use for constructing the factors. Basically, we're going from characteristics to building factors. And here is the factor model we propose. We can construct market size all as from a French standard construction, just using cryptocurrency data. The value we construct is the reversal of the negative of 52-week return. That's the value metric used in, for example, studies of commodities. And we use several other value metrics. They were not significant, such as the ratio of addresses to cryptocurrency price. Network metric is the changes in non-zero balance addresses. And finally, for momentum, we construct that following the Lyutovsky and Wu paper, and that will be our 5th factor. You might ask, are there profitability factor, investment factors? These were not proposed earlier, and it's hard to come up with metrics for that. There are factors related to mining, which we don't have data on, and that's something we are working on as well. But in general, we can do a horse race across all these factor models. In French 2018, the authors talk about both left-hand side approach and right-hand side approach. Left-hand side approach involves creating sorted portfolios, test portfolios, and just see how the various factor models perform in terms of GRS. The lower the number, the better average, the residual alpha, average R square. We can use constraint R squared as proposed in Mao 2000, I believe it's 2018, 2019. And here we're just reporting the metrics we have and the p-value. Overall, the 5-factor model that we're proposing performs best based on left-hand side approach. We can also take a right-hand side approach to talk about whether a particular factor is spent by other factors. For the 5-factor model here, none of the factors is spent by other factors. We can also look at the max square Sharpe ratio test that's introduced by Bareilles and Shankin. Basically, how marginally they are contributing to explaining the residue of the intercept when you regress one factor onto the other factors. And we do see both the value factor, the network adoption factor that we introduce are contributing significantly to the marginal max square Sharpe ratio. That's comparable to typical factors that we use in the equity market. Okay. And then the second part of our paper is really about token classification, and we use the 4 categories proposed actually in a book chapter that Yizhou, Xiao, and I did. Basically, there are general payment tokens that are aimed to play roles of money for the general economy. Stable coins will be in that category. Platform tokens that are means of payments that are associated with particular platforms. Product tokens are NFT included, entitlement to ownership, entitlement to redeeming products or services from the platform or from centralized parties. And finally, there are cash flow based security tokens. And here are the summary stats for the 4 categories within the core sample. The core sample are the data that we have, the characteristics. We observe the characteristics. And of course, not surprisingly, the general payment and platform tokens are the dominant categories, but there are a number of product and security tokens. They show very different, volatility patterns. And in terms of active addresses, you can see a big network effect in the general and platform payment tokens, whereas we don't expect much network effect in security tokens and product tokens. And once we do this categorization, we can actually build a global factor model that we were talking about earlier, and local factor model using within category assets to construct these factors, and also a hybrid international factor model where we construct both local factors and foreign factors using cryptocurrencies excluding the cryptocurrencies within that category that we're looking at. And the general pattern here, we look at a crypto CAPM model, the Liu-Tversky-Wu 3-factor model, and the proposed C5-factor model. Overall, moving from global to local, we see better explanation of the cross-section for the categories, and the C5-factor model performs the best. So what this tells us is there's strong segmentation that's leading to the global factor model not performing as effectively. So that indicates the categorizations are capturing differences across various groups of cryptocurrencies. And we need to take classification and also local factors into consideration when we think about crypto asset pricing going forward. With that, I think I am pretty much at time, or maybe I'm going a little bit faster than I planned. So in this study, we basically did a couple of things. The first one is just to provide a comprehensive documentation of crypto anomalies using a really comprehensive data set. If we think about the earlier studies, when we construct factor models, we are using Bitcoin only, or we're using 10 cryptocurrencies. And here we're really looking at a large, and we have to do more to justify that they are representative in terms of market cap. They are very representative of the cryptocurrency space. And we document value and network adoption premium. We show there's reversal for small tokens and momentum for big tokens. And from that, we add 2 novel factors of crypto value and crypto network, 2 crypto market, crypto size, and crypto momentum factors, and propose the C5 factor model. Actually, if you want to go even more parsimonious, and have a 3-factor or 4-factor model, putting in the network factor and value factor would improve the performance as well. Basically, market, value, and network would also do pretty well. But I don't think 5 is too much bigger than 3 when it comes to factor pricing. And then we did a first empirical systematic categorization of about 700 cryptocurrencies based on their economic functionality. And I didn't get to talk about the functionality too much. When we think about platform tokens, these tokens are used as means of payment, but for specific platforms. For Filecoin, that will be decentralized storage. For Dfinity, that will be decentralized computation. And the extreme of a platform token will be the general payment token, where the platform is the entire economy. Product tokens are very different, and security tokens are cash flow based. That's just tokenization of security contracts. And we know how to discount cash flow. So when we talk about fundamental value there, it's a little bit easier. Whereas when we talk about fundamental value of platform tokens, we have to think about the convenience that they bring to the users. And that's related to user adoption, network effect, the productivity of the platform, so on and so forth. And finally, we borrow tools from international asset pricing to document this strong market segmentation across different categories. And our goal is to share both the factor construction and the data, well, the constructed factors, and also the token categorizations, so that other researchers can explore this information and potentially use the factor models when they think about controlling for certain, I wouldn't call it risk factors because we don't really have a clear explanation yet, but systematic factors, at least from a statistical perspective in their studies. That's what I have to present. Thank you, and looking forward to hearing your both discussion and comments.